Hey guys, my name is Blaine and I'm going to give you some tips and tricks to the stock market, also explaining about how the stock market works. Let's get into it. So to get started, I'm going to explain what a stock is. A stock is defined as a share of an ownership of a publicly traded company that is used on the stock exchange. Common stocks are securities sold in public that constitute an ownership stake in a corporation. So you're owning basically a tiny little itty bitty percent of a company, and as the company goes up or goes down, you get a profit upon how much the company is went up, paid out by the company, or usually the stock exchange. These stocks come in all different sizes. You can have a $20,000 stock. Well, they wouldn't do that, but you could have a $1,500 stock of, say, Tesla. If Tesla did really good, and you would still own the same percentage as, say, the same Apple stock that's $300. It's the same percentage. It's not the same percentage for each company, but it can be the same percentage, and it's just based on how much the company wants to these stocks come in all different types of sizes and, lots of different things that they can do. So you can have a global company like IBM or Coca-Cola or Apple that has a lot of change, little change, but a lot of potential for money, because this company can do amazing in one quarter and make $1 million. Like how Tesla just went from like 878 to like 950. That's amazing, and people just made a lot of money on that. Or you could have a smaller, like $5-6 stock that you can put a ton of money into, and it could drop to nothing, or so saying the small stocks, you could have a 50-cent stock, and the stock could go from 50 cents to 55 cents. And if you have $1 million in that one stock, you're gonna make a lot of money. But if that stock goes from 50 cents to 45 cents, then you're gonna lose a lot of money. So it's kind of a give and trade of which kind of company you wanna invest in and how much you're gonna put in. These companies also. Now, another thing that people confuse with stocks is stocks and cryptocurrencies are completely different things. A cryptocurrency is how to explain it in basic terms really is that a cryptocurrency is like trying to be the US currency. So they're a little tiny, they start out at nothing really. Like Bitcoin started out at nothing, and then people put money into it and buy 50 Bitcoins at 2 cents, and then the stock goes from 2 cents to 3 cents and so on and so forth until you have Bitcoin at $21,000 like it was 2 or 3 years ago. And stocks do change like that when people invest a lot of their money into the company, but a lot more change happens when the company itself has a really good quarter or a really good year, making the change a lot quicker than Bitcoin. And Bitcoin, so there's a lot more cryptocurrencies than just Bitcoin, but Bitcoin is a really good example because Bitcoin has, a lot of people know about it because it was on the news a few years back because it was making so many people so much money. Bitcoin had a lot of change really quickly, and that's why people tried it, and you can trade it the same way that you trade stocks, so people kind of confuse the two, and it's not really the same thing. So when you buy a stock, or you automatically own a percentage of the firm or company and you take stake in its assets. If you paid $100 stock and the stock appreciates by like 10% during the period you own it, you've earned $10 on that stock investment. So you own, if Amazon was a tiny company and they're trading, and you bought that stock at $2 and it's now at $500, you own the same. You've made that money upon what it's grown, because the stock that you own is grown, and it's an asset. It's an actual physical. It's not a physical asset, but you own a percentage of that company because of the way that the stocks are traded. So technically, yes, you do own a part of that brick and mortar building that Amazon ships and trades and all that stuff, but you don't you can't go in there and say, I want my brick, it's mine, because, you know, it's a big change that, and it's not really the same. It's kind of there. So that's the idea behind buying stocks. It's to invest in solid, well-managed companies that turn a profit to make yourself money. A company that succeeds in those fronts stands a good chance of its stock for growing price, having price that's growing, while a company in going public makes use of the proceedings of the original stock to reach growth sales and manage operating expenses. The company can use these cash investments to invest in a new markets, researching products, hire more workers, and, you know, better advertise and all those things. So it's really a win-win for the company and the people, as long as the company is good and it's, you know, making money. You know, the company gets that money and they can go and buy 3,000 new things to 3,000 new trucks. Say it to Amazon again. They're buying 3,000 new trucks to be able to ship out more products, so the company gets more money and growth, therefore turning you a profit in your stock. And it's just a really good win-win, and it can make you a lot of profit, or if you're not smart about it, you can make a little bit of profit, you know. Not that. In most cases, it doesn't take that much effort to buy a stock or own a piece of a company. You would typically just pay the market price for the stock via a stockbroker, or like I use Robinhood, and I use TradingView to see where the company's at and where I should trade, where I should buy, and where I should sell. And I use Robinhood because Robinhood now has no trading fees, which is wonderful. I really like that. I just started using it. It's amazing. And you can receive the confirmation, and it shows up that you own the stock, or you can actually get a piece of paper that says, you know, you own one stock. And if you do that, though, you have to hand it to other people, and then you have to like give it into a stockbroker to be able to change it back. And that's not really how it's done anymore. But you could see another thing in the like 1800s. They would have the stocks, a physical piece of paper, and that's all they had. So you'd buy a stock, I don't know where, but you'd buy a stock, they would give you a piece of paper, and then you own that one stock. And it was basically a piece of paper that said you own this stock. And that was a really terrible system, but what people started doing was printing out actual stocks, you know, basically stocks. It would be a piece of paper with the printed company that said you own the stock, because that's what the stocks were. And it really deflated the company, because, you know, they would turn in the stock and make millions of dollars just because they had a piece of paper that said you own this stock. And that's not how it's done anymore. It's more secure, and, you know, it's better for the company. But, you know, it's where it started. And then another part that I wanted to talk about, like, what is the stock market, the physical trading atmosphere that we use. So there's not really just one stock market. There's a lot. So they're all around the world, and there's, you know, a few well-known ones like the New York Stock Exchange, the NYSE, or the London Stock Exchange, which is the LSE. You know, and there's other ones like the Los Angeles and all those other ones, but they can usually do that's like physical. You know, you see the guys yelling buy, sell, or whatever, and they do it from 9 a.m. to 4, I'm pretty sure. And that's why the people talk about how like CEOs have to wake up, don't sleep, because, you know, that's a fifth of your day that you're using sleeping. And, you know, people who are like super lazy talk about how they don't have any money, but that's because they're lazy, you know. And that's what they're trying to convey, that if you wake up at 9 o'clock on the West Coast, you're already 3 hours behind everyone else, because they're trading, they're up, they're kicking booty in the morning, and you're not even doing anything. So you have to be able to work, and you have to be able to know what you're doing to be able to make a lot of money in the stock exchange. And nowadays people don't usually trade like physical things. It's more of on the phone or on the computer, because it's easier and it's faster, and people can, you know, there's this thing called pumping and dumping. So you'll pump you and all your friends, say, and you're all multimillionaires, whatever. You're gonna put $40 million into Bitcoin, say. So Bitcoin's gonna go from 7,500 to 7,600, and all that, you're gonna get that whatever percentage that is growth on your take, and then you're gonna take all your money out, and it's gonna change, and you're gonna get all that money, but you're gonna destroy the stock because you're taking all that money in and out, and it's really bad for the stock exchange. Now, I hope this raw information talking about the stock exchange and actual stocks helps you guys invest and make yourselves money. The big takeaway things that I would say is you got to know how you want to trade. If you want to trade big companies like with big footing like Amazon or Coca-Cola, or if you want to trade smaller companies and take that risk, that no risk, no gain, right? But and how you own a partial stake in that company, and how if the company does a 10% growth, that you can do a 10% growth on your stock, and that's how that works. And how to buy the stocks, I use Robinhood personally. I think it's really great, and you can do like dividends and all that stuff on Robinhood, which is really bueno. And how cryptocurrencies and stocks are completely different, and how they are similar but don't work the same, and how the stock exchange and how you can do it on your phone and all that stuff. Thank you guys for watching. Please like and please subscribe. It really helps me out, and check out my other videos. Some of them are okay. First one's pretty terrible, but thank you. I'll see you next week. Later. So let's say that you're a multi-millionaire and you want to go and buy 50% share in Amazon, or you want to buy a 50% share in Facebook. You can do that, and the more stocks you own, the more say you have in a company, but that's kind of really vague, because you can go out and buy 300,000 stocks of Amazon, but it's really like you still own the tiniest bit of the company, but you're still making your money upon their growth and their whatever they do to make you money, really. And the smaller the company, the better for you if you want to own a partial stake in that company. But the bigger the company, the more solid footing that this company is going to have is really going to make you more money, because the company's changing less or changing for the better, really. Because these companies aren't, Facebook and Amazon, they're not really going to really dip down really low. And if they are going to dip down really low, they're going to tank like a mofo, and it's going to be a huge change.